We good? Okay. So a couple of things. This is that McKinsey text, the paperback, that I indicated that I think's $25, $35-ish online in decent shape. You don't need to have it. Everything that you need in this class I've already put online for you, and I haven't copied from the text. It's developed. It's things I've developed. Okay. This is the more recent version of it. About a third the size and about 3 times the cost.
It's because it's hardcover.
Well, that's part of it. It's because somebody's making money. Okay, that's the other part. You might be able to find a PDF of these out there. I don't know. I've not seen one. But if you can, cool. You don't need the text, but it is a really good long-term resource for you. Okay? A couple of you had a question about if you're not going to be able to be here some night. Because let's face it, we're adults, we've got schedules, we've got commitments and obligations, and that's altogether possible. Part of why I'm recording these, so you've got access to the video, okay? So if you're not going to be here next week, you can always look at the video. That said, if you have a pattern of not being here, then it absolutely will offend me, piss me off, and cost me, okay? And remember that 10% participation thing? If you start skipping class because you know you can just look at the video, kiss that 10%, and I promise you I'll find some others that you can kiss goodbye. Okay? Don't do it. There is more than what's on the video. That's all there is to it. Okay? My good humor, if nothing else, right? You guys are so polite. You're willing to laugh at the right times. I know I'm not funny. I know this, but you guys are awfully nice. Okay, so let's take a look at what I think are some fundamental principles. It'll help me pass these. This is a crib sheet, if you will. It's a corporate finance quick sheet. It is linked on Canvas for you, of course, under week 1. And there's all kinds of variable, numeric, finance-y kind of relationships here. Okay? This, for those of you that have had any finance, it should make some pretty good sense. Are there enough of those?
We need a few more.
Yeah, you do, don't you? Or you guys just get
At least that's what we don't need.
Yeah, there's 15 of them. We should
I
have.
need one.
Manny's got it right back of you. Turn. There you go. I'm not going to go over all these. Okay? You probably are familiar with most of these from MBA 603 and/or your accounting class. Okay? But you need to understand most of this because these create the inputs to the equations that we're going to deal with. Okay? Yes?
I just have a question. So, my company focuses on EBITDA heavily, but I just always wondered why they would focus on EBITDA prior, when it's all the number that's before all those expenses.
Yeah, in fact, we're going to talk about that in a few minutes.
Oh.
Because that's a relevant issue. That's a
Okay.
big deal. I prefer EBIT, and you'll understand why.
Yeah,
Okay.
it's just a big deal and I don't understand it.
Sure, I'll help you understand. It's good. So those relationships are important, okay? Memorize as much of that as you can. Use it, it's a resource. I would keep it with you. I'd have it with you every class. Okay? I'd have it with you when you're doing any of the problem sets and the homeworks. It's not nothing. There are some relationships on there that mean, there are multiple relationships that mean the same thing. Let me give you an example. One is invested capital. And there are 2 measures of invested capital. One is the operations approach, and you have invested capital, the financing approach. And if we are looking at the entirety of the firm, either way you calculate invested capital, you ought to come up with the exact same number. Okay? So an invested capital in the ops approach is the fixed assets on the balance sheet. So these are long-term fixed assets, right? Plus the net working capital. And you know that net working capital is current assets minus current liabilities. That is the company's invested capital. What that means is, this is the capital on the balance sheet the company is using to make money, right? But it's on the balance sheet, which means it's a book value, it's a historical artifact, it may not be accurate, and it barely has relevance, but it's the best thing we've got. If we could dig down really deeply, which we will not be able to do in this class, But if we could dig down really deeply into the assets that are on the balance sheet, we might be able to create market values for them rather than book values. And that would be better, but that's much more complex. One of the items on the balance sheet might be 100,000 acres in Wyoming that we keep our cattle on. It's got a book value that's okay. Its market value is a lot bigger, right? But how do we find the market value for a 100,000 acre spread in Wyoming? How liquid is that? How easy is it to find a bidder now that will give me its worth? So it's hard, right? So we're going to rely on the book value there. And net working capital, because of liquid assets and liquid liabilities, book value and market value are the exact same thing, right? If you're looking at the financing approach, it's total debt plus total equity. And the total debt is the long-term debt. Column. You know what an account payable is, right? Okay. You know what an account receivable is. So let's say Manny's company is selling some raw materials to you. And he gives you 30 days to pay for them. He delivers them to your dock today. You've got 30 days to pay for them. When he has delivered it to your dock, do you now owe him whatever the price was?
I owe him 30 days from now.
Well, but you owe it, but you don't have to pay it until 30 days because he gave you those terms, right? Okay. Total debt plus total equity. Fixed assets plus net working capital.
The OPS.
Operations versus finance. And you'll find these on here as well. So let's say it's $100,000. When he extended that $100,000 credit to you, right? Did he do it to help you capitalize your business and build your business? Or did he do it to help him sell products to you? Yeah, he did it to lubricate the transaction to make you more likely to buy more from him, right? So a current asset or a current liability, which is largely cash and receivables on the asset side and payables on the liability side, those are not part of the company's capital structure. Those were not extended to the company to build the company. They were extended to the company just in the natural transactional nature of business. It's fluidity, it's the lubrication in the system. Without it, the system grinds to a halt, right? Because, what's he got somebody on the dock with a $100,000 box of money that they're going to give you? You know, it's not going to happen, right? Because your employee is going to run off with it before the product ever gets there. Okay. So when we think about total debt, we think about the capital structure, we're thinking about those dollars that have been invested into the company for the purpose of building the company, providing its capital. Okay? And if you look at the balance sheet carefully enough, you would be able to fairly quickly see why fixed assets plus net working capital equals total debt plus total equity. Okay? It'll become obvious to you. Which is why, if we're looking at the whole company, those are the exact same number. I'm going to ask you to utilize virtually always this form of invested capital. Because Kuhn's got a company. And I'm really interested in buying part of it. Kuhn, is it likely that you and me and your CFO and my CFO can take your balance sheet apart and figure out exactly which part of the fixed assets are part of the part that I want? They're represented in the part of the company I want to buy. You probably can, right? The building, the equipment, etc. Maybe we can even attribute a certain percentage of the current net working capital to that part of the company. So we can use this equation if we parse out elements of the company rather than simply think of the whole asset, right? We can cut it into pieces and still get an accurate measure. However, Shelby, you raised equity in this company 10 years ago. In the last 10 years, has business changed much? Technology, customers, internet, right? .com burst, .com back. Okay? Changed a lot. Do I know what part of the equity you raised is in your operations division versus your real estate division versus your mechanical division? You only had one of them when you raised it, right? I can't parse it out, can I? Same thing with a bank loan. The bank loaned you $150,000. Loaned it to you 5 years ago. In the last 5 years, you've done all kinds of things. I don't know what part of that $150,000 that was loaned to you is in the mechanical division, etc. but I know what assets are there, right? So we're going to parse the company out into its separable parts, of which maybe we're only trying to value one of them, then this is our only shot at accuracy. And if we're parsing this out, this number for that part will be different than this number for the whole company, won't it? Use this part. Okay? So we're going to talk about, at different times, all the various measures on there. I'll use them. You'll be expected to understand them. I'll model them for you before you're expected to use and understand them. And if you have questions about them, for heaven's sakes, stop me, ask me, and if necessary, WhatsApp, text, whatever happens to be, stop by my office. Well, this invested capital thing, as it turns out, is really important. Let me look at something real quick here. I want to make sure I'm not getting ahead of something important later on. Okay, good. This invested capital happens to be really important. It is the capital that we use to make money in our company. It's the physical capital we use, and maybe even the financial capital we use to make money in the company, right? Which suggests that our company, our asset, makes money off of its assets, right? Is that universally and completely true? Companies only make money off of their fixed assets and their financial assets? What do you think, Josue?
I think that's most likely the case for most companies, but I don't know that I would say that it's always the case.
Okay. Sometimes companies make money off of intellectual property, intangible assets that we may not even have a dollar value for, right? Tavita, are you valuable for the company you work with?
I like to think so.
Do they pay you?
Yeah.
I think that they think so then. Okay. If they didn't think so, not so much with the pay, right? Do they own you?
No.
No, absolutely not. In fact, in our society, we outlawed that in about 1865, as it turns out. Now, we do have some pockets across the country and certainly across the world where it's not outlawed. We call that slavery. Okay? We have sex slaves and all kinds of things in this country illegitimately. But for regular folks like us, not so much with the slavery anymore, which is the good news. So we are no longer an asset that could be owned by some other person, are we? None of us. But are we capital
Yes.
in production in a business?
Absolutely.
In fact, we call it human capital. I actually generalize it even further still. I call it biological capital. Because we have some non-physical capital that is also non-human that is productive. If I have a ranch and I herd cattle, I'm pretty sure I've got horses. They're part of my cattle, right? They're part of my capital, right?
Yes.
And they're non-human, but they're biological. So I generalize human capital a little bit further and call it biological capital. We know there's physical capital, there's financial capital, there's biologic capital, there is intangible capital, right? Those are all forms of capital we might have to think about in this whole deal. Well, I want to know something about whether or not this company is able to move forward and grow and make money. Okay? I know that if I take the invested capital and multiply it by the return on invested capital, then I should get some dollar value of what that return is, right? And the return on invested capital is equal to no plat, which I'll come back to in a few minutes, divided by invested capital. These relationships are all on your quick sheet. Okay? So this is what return on invested capital is. I'll discuss no plat in a few minutes. But let me just tell you, it's a cash flow measure. It is some notion of cash flow. It is not free cash flow. It's not EBIT. But there's a relationship there, okay? So if this tells me the dollar value of my return from utilizing these companies' productive assets, this tells me the dollar value of the cost of my capital. WACC, weighted average cost of capital. WACC. How many of you have been exposed to the equation for weighted average cost of capital? Bless your hearts. How many of you took MBA 603 from Rob Patterson the last year? Okay. Same guys? Kind of? You got it from me, didn't you?
I didn't take it.
No, you didn't, okay. You didn't take 603, you tested out of it? Okay, some of this will grind for you a little bit. I know you're really good with numbers though, so maybe not so much. Well, if this is the dollar value of the return on capital, and this is the dollar value of the cost of that capital, okay, and we're gonna talk about the WACC equation ad nauseum, don't worry about it tonight. Then this is the dollar value of the spread between the return and the cost of capital, right? So the invested capital times the spread between the return and the cost. And I'm going to tell you, and I'm going to repeat this next week because this is so important. I'm going to tell you that this is referred to as economic profit. A little pi stands for profit in finance speak. I'm going to tell you that when the return on invested capital is greater than the cost of capital, that growth in the company creates value. Let's think about that. When the return on capital is greater than the cost of capital, then growing the company creates value. If there's a positive spread, getting bigger means more positive value represented in that spread, right? However, so when this happens, G is good. Growth is good, kind of like greed, okay? However, when return on invested capital is less than our cost of capital, then growth, or G, is bad. Because it destroys value. When growing makes me lose more money faster. You guys all have seen examples of this. The one that I think of the most often, I drive home on 13th East. I live in Sandy. Take the Beltway down to 13th East and go home. And I drive past a little place at about 80-something south on 13th East that right now is called Peipei, P-E-I-P-E-I. It's a really good Asian restaurant. It's not very fancy, but it's really good. If you're ever in that area, it's absolutely worth you stopping in, because I'd like them to be there next year. Okay? And if not enough people stop in, they won't be there next year, right? And in the years I've been making that drive, there's been no less than 6 restaurants in that space. And I know enough about restaurants to A, know that I don't want to own them, ever. Okay? Fastest way I know to lose money, or to work about 100 hours to make about $10. Okay? That doesn't seem like a good trade-off to me, Walter. I don't like that measure. Okay? So I don't want to own a restaurant. And I know that people that do own restaurants, they worry and they work themselves half to death. They're there at 6 in the morning, they're there at midnight, and they got to go home and deal with stuff and all of that, and they clean and they cook and they bottle wash and they account, and they're worried because in their heart of hearts, they know if they can grow, if they can get bigger, they'll survive and they'll thrive. And so they do. They're working their guts out and they get bigger. And they go and look at the books at the end of the period and realize they lost more money faster. And the guy or the woman just wants to put something very sharp in something very soft. Okay? And end it now. But they didn't know that that was going to happen. Because they didn't know that the return on capital was greater than their cost, or was less than their cost of capital. Because they don't have the tools. They're cooks. They're great workers. They're not financiers necessarily. Now, I don't care if it's a restaurant like that one, or a dry cleaners, or a car lot, or a mechanic shop, or an accounting office, or whatever it happens to be. How many businesses have you driven by in the last 3 years that one day when you drove by wasn't there anymore? I guarantee you that some large percentage of them had people that owned them that laid awake at night dreaming of how they could grow. Because if they could grow, if they could only get bigger, they would survive and thrive. And they figure out how to grow and they die faster. Cabo, you look like you gotta say something, man.
No, it's kind of like, I see this weird, you know? I think this function for the more than the 90% company is useful, but in China, you know, some companies belong to the country, belong to the government.
Yeah.
But in that time, if the WACC bigger than the return on, the IC, so but the company still survive, keeps them more and more years.
Because the reality is their cost of capital is underwritten by someone else they don't have to worry about, right?
Yeah, we just call that the government just makes the money from the right change to the life.
Yeah, so I should qualify this for a moment, and thank you for pointing that out. I'm talking about metrics that exist in competitive markets with limited government intervention. Okay? And that's going to be true of almost everything we discussed, by the way. You put a great big exogenous body in there that has a virtually unlimited checkbook, and everything else goes out the window. So just know that. Okay? Yeah, that's right.
Quick question. When we're talking about growth, we're not talking about like increasing the profit margin or the net profit, right? We're just talking about increasing your
Scale.
asset.
Yeah,
okay.
in this case, growth to me means increase in the nominal values, increase in scale.
Okay.
Now, we're going to talk about different ways of looking at growth, and we're going to look at them in terms of profit changes,
Yeah.
which is going to, frankly, be a derivative.
Okay.
But we're not going to use calculus to discuss it, okay? Although we could. But I'm talking about just basic, bare bones, construction worker growth, okay? All right. These are some fundamental principles. This is the equation for return on invested capital. I'm not going to write the equation for weighted average cost of capital yet because I think you're going to try to write it down, and I don't want you to take the time to do it until we can really talk about it, okay? But the relationship between these two is inherent with this because this is part of this one, right? This is a big dang deal, okay? Next week we're going to start. Once we finish reviewing a couple of things, we're going to start by talking about this relationship in economic profit. I don't want to go too deeply into it tonight. I don't want to give you too much to keep you awake all night. Okay? Although I know it's that exciting. I really no, it really is to some of us. At least it's exciting. You can tell by the look on her face. Now she's okay. Very good. All right. I told you what enterprise value was, kind of, but I kind of lied. I wasn't being altogether completely truthful for you. Enterprise value, EV, is the dollar value of the company's capital components. Common stock, preferred stock, and long-term capital debt. When I say debt, I'm always talking about long-term capital debt. If I want to talk about current liabilities, I'll say current liabilities. When I say debt, it means long-term, the stuff that's on the balance sheet that was put there by investors to help me build and grow my business, and for which I owe an interest rate and must pay back something. That's what I mean by debt. Well, enterprise value is the market cap of the common stock, which is very often referred to, by the way, as E. I don't know why, but it is. Okay? The market cap of the common stock. How do I determine the market cap of the common stock? Okay?
I don't know, we're trying to think that.
Okay. Junyun, do you know how I get the market cap of the common stock?
Pull out the application.
Okay. So I identify the number of shares outstanding times the current price per share. Shares outstanding, so the shares of common stock that are in the market or in private hands, which is more likely the case, right? Times whatever we think they're worth. Maybe it's really a market value because we have a recent market transaction. Maybe it is some supposed value, but it is that market value of the common stock as closely as we know. Plus the market cap of the preferred stock. Again, the number of shares of preferred stock outstanding times the price per share. Here's something interesting. All companies in the public sphere and in the private sphere have common stock. And they have typically one type of common stock. Class A, voting rights. Every once in a while there will be more than one type, but we're going to act as though there's not. Not all companies have preferred stock, and some companies that have preferred stock have 50 different types of preferred stock. Or 2, or 100. Last time I assessed GM, I think GM, and this was from a historical assessment, I think at their height they had 52 different preferred stock offerings. Because they can issue it at different times, right? It's a different type. and it's got different rights to it, it's got a different dividend rate. Remember, the preferred is controlled by a contract. So if you're going to do this, really, you would have to know all of the preferred share types they have, how many shares of each, and the market price of each one. Good luck with that, by the way. Okay? But it's out there. We can do it. We're not going to be that complex, I promise you. In fact, we sometimes will deal with examples where there is no preferred stock, because that's possible, right? And other times we'll deal with examples where there's one type. I don't think I ever throw an example at you that's got more than one type of preferred. Okay? Because if you can figure it out for one type, you can figure it out for all types. Plus, the value of the debt. Notice I didn't put market there, but I'm about to. If you look at almost any finance book out there, you're going to see that this equation, market cap of common, market cap of preferred, the book value of the debt, minus the cash, or cash and equivalents, is enterprise value. That's the garden variety financier definition of enterprise value. And it is wholly unsatisfying. Because this is a book value. This is a historical artifact. So Ken, you're the CFO of my company. 10 years ago, we floated a 30-year bond offering at 9% interest rate or a 9% coupon rate. Okay? In that 10 years, and that wasn't a bad rate 10 years ago, by the way. In that 10 years, we've gotten much more mature as a company, right? We're stronger, we're more stable, we've been profitable for 10 years plus now, whereas then we barely existed, we were still on smoke and mirrors and fumes, etc. And now, interest rates have also gone down, and today, you're telling me that we can go out and borrow money for 5% in the markets. Okay? Was 9%? Is that what I said, 9? And now it's 5%. What has happened to the market value of the bonds that Ken and I issued 10 years ago, when interest rates go down from 9 to 5%, or just generally when they go down? Price goes up. Why? Imagine, why does the price go up?
Supply and demand. You can find
No, it's actually not supply and demand this time. Think about this. You invested $1,000 10 years ago. That's $1,000 price per bond. That's the face value of 99-point-something% of the bonds out there. So we're always going to assume that's the face value of a bond. You invested $1,000 per bond, and you had a contract that said you get $90 a year, $45 twice a year. Okay? And at that time, that was 9% for you. Today, if you invested in a similar debt offering, similar kind of company, you put your same $1,000 in, if you did it today, you would only expect to get 5% or $50, right? If interest rates are now 5%. Which is more valuable to you? The one that's got $90 a year into your pocket, or the one that's got $50 a year that it gives you?
9.
Yeah, the 90, right? The price went up. Because the one for 50 you can get for $1,000 today, right? It's 5% current yield in the market today, under our little story. If that's the case, the one that's giving you 90 bucks a year is a greater value. And sometimes it's the opposite. Interest rates go up, in which case the market value goes down. Well, you know what? As it turns out, that market value is a combination of a bond equation you guys already know, but you're going to know better before we're done. And it's not a little bit. It's an interaction of how much time is left between now and the time it matures, what the difference is between that original interest rate, the coupon rate, and today's current yield in the market, and that's a big difference. It may be the difference between the book value of $1,000 per bond and a book value of a market value of $1,700 per bond. And that's not nothing on that $10 million bond offering that we floated. That's a huge difference here, isn't it? You learn market book value in your other finance or accounting classes. I want you to think market value. Book values are historical artifacts. They help me interpret the past. They don't tell me about today. And if I'm trying to find a value for an asset today, the past is only good as an indicator and as a foundation for my story. It doesn't give me the number today. I need to be here and now, because I'm going to write a check that's going to clear my bank now. not in the past, right? And nobody's gonna hang around and keep it for the future. Why? Oh, by the way, this is often referred to as the variable P. This is often referred to as the variable D. Why do we subtract cash from these asset types to get to the enterprise value of a company? And enterprise value means the value of the company. Not just the value of the common, but the value of the entire capital structure of the company. Why do we subtract cash?
Is that what, that's what your profit is, right? You have to pay out to the market common stock and the market.
Say that again,
preferred stock.
please.
That'd be the profit.
Not necessarily. That cash might be there because they borrowed it the moment before I bought the company. Okay. Elisa, if I want to charge you $100 for something, and at the moment that you're paying me, I give you $10, I want 100 from you, but the moment you're paying me, I give you 10, did it really cost you $100?
No.
It cost you 90, right? That's why. Because the moment you own the company, you own that cash. Okay? You didn't have to float that cash. You didn't have to finance that cash. The moment you own it, the cash is yours. That's why. Okay? Yeah, please, this way.
Question on the on debt.
Yeah.
And do you think more companies? I mean, for what I've seen on with Goldman and JP Morgan and everybody else, we are actually fair valuing every single day, pretty much everything in the balance sheet, right? Is that a trend for like other companies, smaller companies? Because I mean, I get your point where like book value is just historical data, right? I mean, it may be different. But for most companies, bigger firms, we are actually fair value and trying to find what the mark-to-market price, like the movement.
Say that term again. What price did you just say?
The mark-to-market.
Mark to market. Somebody other than Josue, what does that mean? This is a big deal. And this is the heart of why you're doing it, by the way. Okay? Okay, I'm going to come back to that in just a second. Here's why what you're doing is right and why few companies do it. It's right because that number is now. It's real. It's contemporary. Millennials will even respect it, for heaven's sakes. They don't respect anything, do you? Right? Okay.
For millennials.
Yeah, some of you are, some of you aren't. Some of you have simply bypassed that unfortunate condition. Okay? That's why it's important. The reason why most companies don't do it is most of us don't have the sophistication of Goldman, Blank Bell, Sachs, right? That's a very sophisticated company that's got extraordinary tools and access to knowledge that can do that. You can go into FactSet in the CFA, you can work yourself silly, and it'll take you months to try to figure out how to determine the market value of the debt. If you ever want to know, I've built some models and spreadsheets to help you do it. Okay? If you really want to know that badly, I'm going to want to know why, and maybe we got to go out and buy you a life. Okay? Because it is very unusual that you would want that. You can go into Bloomberg and you couldn't find it to save your life. But it is now. It's the most real thing, and that's important to know that. Mark to market. So here's the thing. There was a time in this country where we believed that real estate only went up in value. Can you suppose such a thing? No. Isn't that just silliness? Yeah. But if you asked me this question about 10 years ago, 12 years ago, most people around would say, oh yeah, it's only ever gone up in value. But then very quickly we found out that wasn't necessarily the case, and we had a crisis and we almost all died. Okay? Here's why it was so dynamic, the near death. I'll take Chase. JP Morgan Chase is a good example. JP Morgan Chase has an extraordinary amount of real estate and mortgage asset on its balance sheet. And when the real estate goes up in price, in value, a company like JP Morgan, or any other at the time, look at it and say, well, you know, over the last calendar quarter, this increased by $100,000. We're going to mark that asset to the market. We're going to adjust its value to the market. So we're going to increase the value of the asset on the balance sheet. Well, you know enough about accounting to know if you change a number on the balance sheet, it's got to change somewhere else too, right? And it's either got to change on the liability side, or it's got to change on the income statement and come in as retained earnings. okay? So, we're not gonna change the liability, we're just gonna we're gonna change the value of the asset because it went up in price. And so we note that increase in price as unearned income. And the markets don't care, income earned, income unearned. The markets like income and create a production value, which was up here earlier, for the asset based upon some of its incomes, right? And so these assets were rising in value at a, not exponential, but a dynamic rate because of the leveraging effect on these balance sheets as these assets were going up. Please.
But unearned income, that's a liability for a company.
It depends. It is now. Let's call it extraordinary income, so that you don't have a heartburn.
Okay. Yeah.
Yeah. So yeah. At the time we called it unearned income because they didn't have to do anything to earn it. But today we don't allow for this for the most part. Okay. So interest rates start to go up. Adjustable rate mortgages start to fade. Property values start to go down. And all of a sudden, the real estate assets were declining in value. Well, if it helps you with income on the way up, and you are marking it to the market every calendar quarter, what does it do to you on the way down? Remember, leverage amplification, dynamic. It hurt just as bad, but maybe worse on the way down, because when you have declines in stock prices, sometimes people that purchase stock on margin, they borrowed money to buy it, have to put in more money. If they don't have the cash to put in more money, they got to sell the stock. And when you have to sell a bunch of stock, what's it do to the value of the stock? Drops further, which means they have to put in more and drops further, and all of a sudden we have a great recession. Not to mention that, good news is we had all these mortgages on the balance sheet too, right? They're great. They're not suffering from this. We haven't necessarily been marking them to the market, although maybe we could have, and some actually were. The mortgage, man, that client's going to pay the mortgage, right? Except for the millions of them that simply returned the keys to the bank or trashed the inside of the property, house, etc. Didn't bother to return the keys to the bank, just walked away and let the bank come figure it out. And all of a sudden the mortgages weren't worth their book value either. Mark-to-market accounting was responsible for a tremendous amount of the rise in the stock market prices in the run-up just before the Great Collapse, and responsible for a tremendous amount of the dynamic and haste of that crisis and collapse. And for a period of time, you couldn't mark-to-market anymore. It was no longer allowed. The rules have all been rewritten now. There's some much tighter parameters around which we can mark-to-market. Only certain kinds of companies with certain kind of assets can. But that marking to the market was a big deal. Knowing what our market is, our market value of all of our capital inputs is at any moment in time is a big deal. That's the number, by the way, that we're estimating when we calculate a production value. Enterprise value is going to equal our production value. Enterprise value we observe, right? Market values, things on the balance sheet. The production value we estimate. So when we're estimating a present value for a company, we're estimating its enterprise value. And maybe if it's a publicly held company, we can estimate it and then compare our estimated number to the enterprise value. When you watch the Damodaran video for the assignment, he's going to talk about that a little bit. He's going to talk about, I think it was Tesla, maybe it was Apple, where he values periodically and never goes and buys because it's always got a higher enterprise value than his estimated value, which means someday he thinks it's going to drop. And since we don't know when, he doesn't want any part of the deal, right? Maybe that's a mechanism, a method that serious investors, not traders, which are in and out all the time, but investors, Warren Buffett's, etc., Bill Graham's can use. Okay?
So you want the EV to be equal or greater than the production to be to
just the opposite. I would like the enterprise value, or that which it is selling for in the market today, to be less than its estimated value. Because if it is, that means I can buy it for a lower price today, believing that it's going to rise to the higher estimated
So
value.
basically, that's the protection is basically the potential.
Yeah, because the production is based upon future cash flows, right? Do we know what they're going to be? We've estimated. And, I probably have a pretty good idea what they're going to be over the next week, next month, the next quarter, the next year. Maybe if I'm a sophisticated company, the next couple of years. Do I have a good idea of what my company's cash flows are going to be like in 10 years?
No.
No. Even if I say I do, I don't. I'm just guessing. And every time I step out on that limb, it gets a little shakier. Time is the distance out on the limb, right? Further out in time I project, forecast, the shakier, the less credible my forecast is. You'll see the effect of that later on in our class. Not now. You're going to also see a relationship at some point that is V is equal to E plus P plus D. V is equal to E, market cap of the common, plus P, market cap of the preferred, plus D, the market value of the debt. Such that if I have a value that is E over V, remember E plus P plus D equals V. If I have E over V, this is the percentage of the company's capital structure that is common stock, right? This is its weight. We're going to talk about weighted average cost of capital next year. That's its weight. P divided by V is the percentage of the company's capital structure that's preferred stock. And then D divided by V is the percentage of the company's capital structure that's represented by its debt. And E plus P plus E over V, the weight of the common, plus P over V, the percentage or weight of the preferred, plus D over V, the percentage or weight of the debt, equals 100%. And if it does not, count it again. Something's wrong if it does not.
So this is check.
Pardon?
This is double check.
Yeah. And you're going to find there's a whole bunch of things that I will talk to you about where I'll say, I always do it both ways to just make sure I did it right. Because double checking or having a check digit uncovers a tremendous amount of problems sometimes, and you want to uncover them yourself. You don't want the investment banker to uncover them for you. Manny knows that.
So you didn't mention the cash and the because you've got the market the common.
Yeah, that's why I didn't say
EV.
EV and V equal to each other. They don't. This is the enterprise value of the company, or what should be equal to our estimated production value. The nominal values, market or book, of the capital structure may be different. Okay? These are not intended to be the same thing. And you'll see when we talk, Nazin, about the weighted average cost of capital, it'll become more obvious to you next week. Just believe me for tonight. Okay? Believe it or not, we're almost there tonight. You guys okay?
Yeah.
Okay. Help me, okay, I want to talk about cash flows for a minute. Is anyone not comfortable enough with the income statement to understand what I mean by EBIT or operating income? Anybody? Be honest. Okay. So if I take the company's revenues minus the company's expenses, operating expenses, which includes depreciation, by the way, I have operating income, which is the same thing as earnings before interest and tax. I'm actually coming to your question. Was it Sophia or Elisa? Elisa. Okay. I'm actually coming to your question finally, an hour and a half later, right? Okay. Like most elephants, I don't forget. It takes me a while. So that's earnings before interest and tax. Well, let's talk about the relevance of that. Chris, you own a company. I own one that's virtually identical in every way, shape, and form except you paid for your company all cash. You wrote a check, you didn't borrow a dime. I paid for my company $20,000 down, and I borrowed the other $80,000. You simply wrote a check for $100,000. Fair enough? Same market, same kinds of employees, same kinds of productivities, the exact same operating income. Which of us will have the greater taxable income or net income?
You will, or
Well, let's think about it. If you take EBIT, this is for Chris, EBIT minus 0 interest minus, I'm just going to say X or T for tax, I get some net income, right? Okay. For Rick, same EBIT minus, let's say $100 for interest minus T, I get net income for Rick, which is less than net income for Nick, or Chris, right? Okay. That makes sense to us. I'm making the assumption at the moment that the tax is the same. That's not a very good assumption, but it's simplifying for our example. But they're the exact same company in every way, shape, or form. If we can value our company based upon its cash flows, and I think that net income arguably is some kind of a cash flow, right? It's an imperfect cash flow, but it's some type. If we can value our companies, and we have the virtually exact same kind of company, mine, did I do that backwards?
The other way around, yeah.
I did it backwards. Thank you. You guys need to be willing to point that out to me. I won't be offended, but I will remember. So in this case, mine's got a smaller cash flow, if you will, which means it should have a lesser value. But they're the exact same company in all shapes and forms. Why should one have a different value than the other?
Debt. And
Yeah.
interest in the debt.
Because they should not, and there's a couple of guys out there by the name of Modigliani and Miller, and they created some really interesting postulates that we won't go into too much detail on, certainly not tonight. And they're economists, and they won Nobel Prizes for these things. And they said that the way you capitalize a company should make no difference in its value. Because its value shouldn't have anything to do with how the owners decided to capitalize it. Maybe I chose to go into debt just because I wanted to. I wanted to keep the extra 80 grand in my checkbook. It was a discretionary decision. Should it change the value of this company or these companies? Absolutely not.
Doesn't matter the size of the debt?
Pardon?
Doesn't matter the size of it?
Doesn't matter the size of it. Doesn't matter. Because how you chose to capitalize at Madison versus me versus Ken versus Colin shouldn't make any difference in the value of the company.
Because assuming that you can pay the debt.
Well, we're assuming a lot of things, right? We're economists. We're assuming all kinds of things. And when we finish assuming, we have a whole other hand to assume with. Okay? That's why I like being an economist. All kinds of flexibility. So, EBIT is an important measure. Remember I said that depreciation had already been subtracted from revenues because it's one of the operating expenses to get to EBIT. There's another measure, and it's EBITDA, which is equal to operating income plus depreciation. It's earnings before interest, tax, and depreciation and amortization. Depreciation is depletion of value of a tangible asset. Amortization is depletion of value of an intangible asset. So when I say depreciation, I'm really talking about D and A here, okay? Depletion of value of the assets, tangible and or intangible. So EBITDA, here's why I don't like EBITDA, Lisa. Because it doesn't recognize the expense contribution of depreciation, which means it doesn't recognize the capitalized expense of the asset that the firm is using to create money with. The printing press. You take away the printing press from DeVita's company, and unless he's really good at drawing, he's not doing anything and selling it, right? If we don't recognize that, I think we are missing an extraordinarily rich part of the equation, certainly as it has to do with valuation. Okay? Now, that said, the vast majority of financiers at all use EBITDA because they don't want to deal with the imperfection of depreciation as a measure. How many different depreciation schedule types are there, Josue? Do you recall?
At least 4 or 5.
At least 4 or 5.
Yeah.
And they all come up with a different number. And when we are accounting for our company to try to give some notion of what's really going on, not for taxes, but for practical purposes, we get to choose the method. For taxes, we may have to choose a particular method, that which is allowed by the IRS law, etc. But for just trying to explain to our stakeholders what's going on, we get to choose the one. Okay? Well, do I choose accelerated cost recovery system? Do I choose straight line? Do I use double declining balance? Do I use modified accelerated cost recovery? Do I use 7-year, 5-year, 10-year hike? I get to choose, right? Okay. So there's an imperfection in the depreciation method. So when we talk about this being a more perfect measure, I'm making an assumption that we've used an appropriate depreciation schedule that is as close as we can get to the real depletion and value of the asset. We know it's imperfect, but we know it's better than not representing it at all, which is what EBITDA does.
For the class, are we just using a straight line?
Well, for the class, we're typically not calculating
Oh, we
depreciation.
don't have to calculate
I'm almost always, I think I'm always giving it to you.
Okay.
Yeah, yeah. Yeah, we're not an accounting class. Thank goodness, by the way.
Thank you.
How many of you are accountants? You know, I love you, Josue, but I don't know
Just
from
one,
where you
Josue?
get the will to live. Okay. All right.
Poor Josue.
So those are two notions of cash flow. Recognize that revenue is an input to each of these, right? But I didn't say revenue is a cash flow, did I? I mean, you might say that, but it is the most imperfect cash flow because you know that it's not all yours. You got to pay the bills, okay? Maybe operating income is all yours. If you have no interest expense and you have no tax, which is possible, then EBIT is your cash flow, isn't it? It's your profit. It's your cash flow. It's that which you get to take home. It's that which you get to divvy out to the common shareholders after you've paid your interest and after you've paid your dividends to your preferred shareholders. Okay. There's a really interesting concept or term, NOPLAT. Net operating profit less adjusted taxes. And if that's not a convolution, I don't know what is. But it's important and it's pure. And we use it in valuation. And I'm about to help you understand why. NOPLAT is equal to EBIT, my preferred operating income measure, times 1 minus the tax rate that would be applied to EBIT if a tax rate was going to be applied to EBIT. Remember the tax calculator I showed you earlier? So if you know what EBIT is, you've got that calculator, type it in, you know what the tax dollar amount is, you know what the tax rate is, average tax rate. Okay? So whatever the number is for EBIT, let's say it's $100,000, times 1 minus, today we have a 21% corporate tax rate, 0.21, or 100,000 times 0.79, right? Which I think is $790,000, if I do my math right. And sometimes I don't, but that was easy by design. Okay, that's why I used $100,000, Walter. Okay? That's my NOPLAT. It's my net operating profit less an adjusted tax. Why am I taking some theoretical tax off of this EBIT and calling it NOPLAT, which is an important cash flow measure, an important input to a cash flow measure? Why do I do that? Because regardless of how I capitalize the asset,
I'm gonna pay the tax.
regardless of what my tax rates are, and tax rates are not pure, are they? Josue earned 100 grand in EBIT, I earned 100 grand in EBIT, we each have $1,000 in interest, so we got $99,000 in taxable income. Josue pays $1,000 in taxes and I pay $10,000. Maybe because he bought a new Tesla and has a tax credit. Got nothing to do with the operation of the business, right? Maybe because he put some solar panels on his house. Maybe because he moved his business to Payson and they gave him a really interesting tax benefit to do so. Maybe because he got a loss carry forward from a prior year. Maybe a whole bunch of things that have nothing to do with the operation of the business now. So we're trying to get back to a number that is void of any of those disparities and discretionalities. Discretionalities? Well, that's a word now, as it turns out, because it's on video. Okay? Don't look it up. I don't look it up on video. Sophia's always saying, hey, where'd that come from? That's a Bushism. Yeah. I'm sorry, I can't hear
It's
you.
the wrong number.
Is that the wrong number?
Yeah, 79,000.
Oh, good grief. And you guys let me do that. Thank you. I have one good friend in the audience. Who knew it was Kaibo? Thank you. Kaibo and I are going to Italy together. We have a great time. Right? Okay. So no plat's a big deal to us. It is different than no pat, which is net operating profit after taxes. One is net operating profit less adjusted taxes. The other is net operating profit after taxes. What's the difference?
Taxes.
Yeah, remember he paid 1,000, I paid 10? So if we both have the same EBIT, 100 grand, my no pat and his no pat are different because of something that's got nothing to do with the operation of the company, perhaps. Loss carry forward, Tesla credit, et cetera, right? Yeah, please.
So just to understand, would no plat be more like a hypothetical,
Purely theoretical, absolutely.
and no pat is the actual?
Yeah, right. But unfortunately, the actual is tainted by events that have nothing to do with the operation of the company this year or in the future, right? And yeah, one is theoretical, no plat. That's a really good insight, by the way, Lisa. Good for you. No plat is theoretical, but it lets us use the exact same measures in theory to get to common numbers, or numbers that mean something in the same realm, right? We've not tainted them, and we need something that's not tainted. Because Walter has retained me to value part of Mazen's company. He's looking at buying it. He knows that Manny's looking at buying it as well. And he's got cash, and you've got cash and credit. There's no reason that the value that Mazen should sell it for would be different to Walter than Manny, right? Unless one of them's just a better negotiator, which, let's face it, might be the case. And I'm not even going to venture to say which, because I wouldn't play that game tonight. Although I do have a thought about this. So there's no reason it should be different. But it would be different if we're using net income, taxable income, no pat. It would not be different if we're using no plat. We've gotten down to where we've stripped away the eccentricities of the discretionary decision. Please, Josue.
But that is only if the company that we are evaluating is something else, like something other than a C corp, right? Because like your
No,
taxable
it
income.
can be a C corp.
Well, no, that's what I'm saying. If you have an LLC, then you and the company are disregarded like same like. Your personal tax rate will be applied to the company.
Which is why I don't want to use my personal tax rate.
Yeah.
I want to use that theoretical tax rate.
Mm-hmm.
I want to input EBIT into the tax calculator and find the rate, because my personal tax rate may be completely different, right?
Okay.
Let's face it, I went bankrupt 4 years ago, and I'm carrying forward losses until the cows come home. That's got nothing to do with the, I didn't go bankrupt. That's got nothing to do with the value of the asset, right?
Yeah.
Or at least not 4 years ago. So it's got nothing to do with the value of the asset, right?
Yeah, that's what I'm saying. If the company is a C corp, then the taxes will be set at 21%, no matter what,
Well,
right?
today,
Oh, okay, yeah.
today. So it would be 0.21 regardless.
Yeah.
Today.
Today.
Yeah.
That's okay.
Yeah. And today, and we've got what, 8 months under this? We get to do an accounting for taxes under this new mechanism.
Mm-hmm.
I guarantee it's going to change.
Okay.
I just don't know exactly how or when. Okay. We're talking about all of this so that we can get to the king of all cash flow variables. Let me do this by way. So this is EBIT minus tax paid. We want to get to the king of all cash flow variables, king of the jungle, and that we're going to use in almost every valuation that we can think about. And that is free cash flow. FCF, free cash flow. Now you can go on as Investopedia and something.com and you can find different definitions of free cash flow. But they all boil down to two different equations that look very different and under the right conditions end up with the same numbers. Okay? I'm going to give them both to you and then I'm going to give you a caution as to when you use one and not the other. And we're going to repeat this because next week because it is that important. Let me get rid of some of this here so we have more space. And I'm going to change coloring. How important this is. Free cash flow is equal to no plat plus depreciation. So I've given a nod to EBITDA, haven't I? No, I can't stand EBITDA. No plat plus depreciation minus change in net working capital minus net capital spending. No plat plus depreciation minus change, that's what that little delta means, that triangle, change, in net working capital minus net capital spending. So let's talk about those last two measures. I think we understand a little bit, no plat, right? I think we understand depreciation. We can either find it or, for our purposes, virtually always on the income statement and balance sheet combination for us. But what is change in net working capital? Well, net working capital, I already know. I'm going to put it over here. So net working capital is current assets minus current liabilities, right? Well, if I have current assets for year one, current liabilities for year one. Net working capital, or change in net working capital, is equal to net working capital for year two minus net working capital for year one. And years 1 and 2 are generalized. A year that's come later versus the period or year that was before. I could have said A and B. I could have said 1 and 0. But they are two periods of time that are separated by one period of time. Okay? So that's the change. What is net capital spending? Do you remember? You should have had this in finance or MBA 603.
Fixed assets?
Pardon?
Fixed assets?
Okay, yeah, okay, cool. So net capital spending equals. Oh, are you reading it?
Yeah.
Okay, good for you. I'm proud of you. Let me just do it for you. Fixed assets from time 1 minus fixed assets from time 0 plus depreciation. Net capital spending. Why did I add depreciation? Is that did I leave something off of that? Is that it? You've got the script sheet in front of you.
Yeah.
Okay, all right. I just had a little thing in the back of my head that was a little light going off. I wanted to make sure I hadn't screwed something up because I can, by the way. Okay. So net capital spending, or the dollar amount we spent on new capital, new fixed assets, capital this period. Okay. Well, fixed assets from time 1, so the most recent period, minus the fixed assets from the period before, that kind of sounds like the amount of money we spent on more fixed assets, right? But remember, before we put this number down on the balance sheet, we depreciated it. So we got to add depreciation back in. Okay? If we don't, then all we have is the difference between these two numbers, not how much we spent getting to fix this new fixed asset. So this fixed asset value, by the time we write it down on the balance sheet, has been depreciated. Non-cash expense. And so we're trying to figure out when we spent cash on assets, we got to add it back. Okay? Well, as it turns out, when I take my no plat plus depreciation minus the change in the net working capital minus the net capital spending, I have my free cash flow, or the cash flow the company generated that I am free to deal with. I haven't committed it. It's mine to deal with, to give to the stakeholders, right? And if I'm the stakeholder, it's all mine. But if Manny's got the common stock, Ken's got the debt, Colin's got the preferred stock, then it's committed out to them. It's the stakeholders' cash flow. Now, as it turns out, the board of directors, by virtue of the CEO's activity, manages what happens to that, right? Some of it might go out to common shareholders. Some of it might go out to preferred shareholders. Some of it might go out in interest expense. And what doesn't go out becomes retained earnings. And we reinvest inside the company, which makes the company more valuable, right?
So dividend?
Pardon?
Dividend?
Well, we might use it for dividends, or we might use it because we want to just keep it for ourselves inside the company. It's ours to use as we see fit as we're managing this asset for the stakeholders. Well, this is the common equation for free cash flow. It is the equation I will beg you to use in virtually all but one instance. There's another equation. That equation is free cash flow is equal to no plat times 1 minus 1 divided by G. Hang on. Yes, G divided by ROIC. Excuse me. Now I got that same little red light going off the back of my little head. No, that's right. Okay. I have a raging inferiority complex, and what motivates this, by the way. Well, no plat's the same in each one, right? Change in net working capital and net capital spending is, at least in some respects, reflective of growth, is it not?
Yeah.
Okay. G. A little hard for me to talk about how return on invested capital comes in here. Later on, you're going to understand it. This particular form of free cash flow is only to be used in the KVD construction. Key value driver. KVD. Key value driver. And the KVD construction is only used when we're trying to think about a continuing or terminal value for the company. I don't want to go into details of what I mean by those tonight. Some of you are already at overload. I get it. Okay? So I'm not going to deliver anything more to you tonight. We're stopping here with new stuff. Okay. Sophia, you're welcome. Okay. I did this in red on purpose. I've seen students lose many, many points by interchanging these. This is used virtually all the time, except for when this is used, and this is only used when we're using the KVD construction, which you would be expressly told to use, okay, of the continuing or terminal value. Always, always, always otherwise use the garden variety, in this case blue, equation for free cash flow. Free cash flow is the king of all cash flows. So when we talk about valuing the future cash flows, we are talking about valuing the future free cash flows. That is the purest. That is the most important. That is what we as stakeholders, managers, decision makers, board of directors actually have access to either give out or reinvest in.
So, sorry to phrase that again. So we use the free cash flow, the first one, unless we have the KVD.
Yes, unless you are expressly told or have a reason to use the KVD equation. And I'll describe that to you in future weeks, not tonight. the KVD equation, which we only use when we're looking at a terminal or continuing value for a company. So it is a somewhat unique circumstance. Okay? However, what if I know the free cash flow because I calculated it by this? No plat's pretty cut and dry, right? EBIT times 1 minus tax rate. Depreciation, I got it off the income statement. It is what it is. Change in net working capital, got it right off the balance sheet. It is what it is. Net capital spending, I got it right off the balance sheet. It is what it is, right? And I had an income statement element on there because of depreciation. I should be able to, without too much trouble, calculate the blue free cash flow, shouldn't I?
Yeah.
Yeah. No plat is no plat, right? Return on invested capital, 1 is 1, by the way. Are we okay with that? Return on invested capital, that's also pretty easy. No plat divided by invested capital. Invested capital is fixed assets plus net working capital. Pretty cut and dry, is it not? If I know this number, can I reverse engineer and find that one?
Yes.
G, hallelujah, amen. I might regrow some hair. As in, there's hope.
No, I like my
There's
haircut.
hope. The rest of you have been hopeful for a while. You have reason to be hopeful. I do not. Okay? You're going to understand in about 5 weeks the importance of what I just said. I just wanted to introduce it so you get used to looking at it.
So it's always a standard that we can use that FCF equal FCF, so I can back calculate it too.
Well,
Because you mentioned there's a construct and there's a scenario. So
yeah. Very sophisticated, theoretical, and problem solving. Garden variety, mechanical, we're going to use it almost all the time. Okay? Don't start to interchange them until I say, hey, let's interchange them. Okay? Because if you do it before then, not so much with the good. Okay? Bad happens. Okay? And bad happens because we have a hard time identifying the real rate of growth. It's elusive, it's mysterious. It is in front of us and fleeting, and I saw it and I don't recognize it again. It's killing me, as it turns out. Okay, so I've given you a lot of stuff. Let me introduce a problem set. This is, you're only going to do items A through G. And I talked about every one of these items tonight. You have them all on your quick sheets. They are all relatively simple. As you go through items H through M, less simple. We'll talk about those next week. The values that you're going to use to answer the questions are on the balance sheet, income statement, and limited market value data on the back. Okay? So here's something I'm going to encourage you to do. Do we need another one?
Yeah, one.
Oh, there you go. Thought I had enough. I'm going to encourage you, and next week I'm going to require you, to take the income statement balance sheet construction and create a spreadsheet that replicates it, that does all the math for you. On that little quick sheet I gave you, there's net income, there's return on invested capital, there's return on equity, there's IDR, STR, depreciation, blah, 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 right? You can use this information and find every one of those things. So if I were you, I'd open up a spreadsheet, I would replicate this so that everything that's going on here math-wise is done by the spreadsheet. You're simply inputting primary inputs. And all those relationships you see on the quick sheet, put those into the spreadsheet down below and let the spreadsheet calculate them from these. You will thank me. Suggest that your next born child will have my name, if not my unfortunate looks. Okay? If you follow me on this, I promise you, it will save you hours and hours. I'm not going to go through this set other than to tell you, and this is important, that virtually all of the problem sets you have, and we're going to have a new one each week, these are online, they're linked, and the problem set as you have it is linked as a Word document, an MS Word document. right next to it, the solution set is linked as a PDF. There is no reason to not complete these and turn them in on time, other than being just double dumb. Because the solutions are there for you, or maybe just really forgetful.
Then what's our job if we have the solutions?
I'm hopeful, Ken.
I know.
Okay, all right.
I know.
So, remember on the problem sets, it's worth part of your grade, right?
10%.
And yeah, it's not an insignificant, right? Do them well, do them on time, you'll do that. I don't really even look to see how accurate you did them. Because if you didn't do them accurate, you cannot read and replicate and write. It's that simple, because I give you the answers. But do not simply copy the answers and turn it in and not know, because a day of reckoning is going to come. I promise. It's obvious in the assessment. It's less obvious in your paper, but it's still clear. If you don't know what you're doing with all this, when you write that paper, I can tell. And that's not an insignificant part of your grade when you take the assessment in your paper. It will make you or break you. I give you the solutions not for you to copy, but for you to use as guideposts. So you're going through this and you've done number one, you think, I think I know the answer to this, let me check. Oh yeah, I'm good. Or, oh, whoa, 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 whoa. How did I get the wrong number? And now you start to reverse engineer and figure it out. That's how you use the solution sets. Somebody in here, probably more than one of you, will use them to simply copy the answers. I will not know who it is until the assessment. And then I will really know who it is when you turn in your essays. And I will then see you the next block. Unless you like fails on your transcripts. And honestly, it's how it goes. Okay? I've done this before. Are we good? What kind of questions would you have?
So are you going to send us an invitation for the WhatsApp?
Yep.
Okay.
Probably not till tomorrow, though.
Okay.
Yeah. Okay? So, you guys heard a lot of stuff about this class, right? From other people. This wasn't that bad, right? 1 down, 6 to go. We're good. Okay, I'll see you guys next week.
Do you want us to turn it in paper or?
Excuse me, Sophia, this one's in paper.
Okay.
This one's in paper. Is due at the start of class, not the end of class, not 20 minutes after class is supposed to start and you're in the CFA finishing it. Okay? 6 o'clock, you turn them in. It's not here at 6 o'clock. Oh well.
So
Over for you.
did you say we're turning paper?
Yep, this one in paper. Now, if you would like to submit it electronically in advance of that, I'm okay with that, but you don't need to. Some of them I require that you submit electronically. This one I don't require.
Okay.
Okay?
Would we hang on to the,
Pardon me?
would we just hang on to the packet and turn it in on a separate sheet of paper?
No, in fact, in this, in yours, you should have place to do all the work.
Yeah. Okay. Because I know that we're gonna do the other problems, right?
Yeah, I'm actually good at that.
Oh, okay.
If we do it electronically, then we submit the Excel with all the formulas, so you can see.
Oh, good question.
Yeah, because that's what.
That's not for this is important, hear me. So Josue asked, if you do it electronically, put together a spreadsheet, you can submit the spreadsheet, and absolutely, but the reason I give it to you as an MS Word document is you must take the numbers from the spreadsheet and insert them into the MS Word document. What I will look at is the MS Word document, whether it's handwritten or typed, downloaded, uploaded rather. That's what I'm going to look at. That's what I'm going to adjudicate. If you gave me a spreadsheet, I'm going to check it a little bit. If you want me to check it rigorously, send me an email and say, hey Rick, I did this spreadsheet. Will you check to see if I was on the right path? And you're also going to find every one of these types of spreadsheets is on that list of Excel templates. I've already done it for you. But you've got to figure it out yourself too, otherwise you don't know how to manipulate what I've got. And I promise, no two income statements look the same.
So you can still turn it in electronically.
Yeah, turn it electronically, but turn in the MS Word doc that has the answers embedded in it, even if you brought them from your spreadsheet. Also give me your spreadsheet. Okay? And yes, you're going to turn it in again because it answers H through N.
So
Yeah,
the only thing due for next week is the quiz and this.
the demoter and quiz and this,
Okay.
A through G.
And it's just to bring the paper for you, right?
Say what?
I'm gonna call
Just to
you.
bring the paper for you before the next class, right?
The paper, you mean,
Yeah, as a homework.
this, the homework completed?
Yeah.
Yes,
Oh,
yeah. And the quiz online about the motor and
if I just submit the electric, I mean, submit the Word, it's online, so do I need redaction for you, or?
I did understand what you're asking me, I'm sorry.
I mean,
Your accent is a little bit difficult for me and I apologize. It's my fault, I do.
You know, I mean, it's.
If you submit it digitally, that's fine.
Yeah, do I need, because it's not pretty.
So one thing I don't understand, can we hard type and
But later on.
submit a hard typed one, or do we have to type it?
Either or,
Either or?
yeah.
Yes, sir.
So when we finish together? I don't know.
I would like to.
The only challenge is that most of my homework is done on Saturday. That's a challenge.
I did most of my homework on Saturday. So I don't have a car, but I could probably take my husband for Saturday.
How do you get it? You don't have a car.
I have a bus pass. I get a free bus pass. on it.
Are you taking a bus right now to go home?
No, there's no bus to 211. My husband's picking me up tonight.
You ready? It's gonna be good.
It's gonna be fun. Yeah. And we do need class?
Oh, I got a lot of jokes, so I'll keep us going.
So luckily, we don't have to meet up this week, we can just meet over text. It's when we start doing the homework on our own, when we'll have to meet up.
That's all.
You can run through the text message. We don't have phone with each other.
What's that? We're just right.
When we get, well, no, WhatsApp, because WhatsApp is going class. So we can run through, we can create our own group for the WhatsApp.
I'll work on it, and then I feel like. So taking this class 3 times. This is the 3rd time she's trying to do it. Well, I dropped out before because I had like 2 concussions, 2 accidents, yeah. Now I'm like, going, okay, I'm gonna stick.
What kind of accident?
What's that?
What kind of accident?
I had 2 car accidents, 2 concussions. I bought a brand new car and, this last time, and I came here and I had a black and brown boot on, and so I went home to change, and a guy ran red lights.